Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of the hosts for today. We've got a full power hour for you. We're going to kick things off with Barry Melanson talking about the rapidly evolving banking situation and other updates from DC. We're then going to have Lisa Simpson provide a technical update, another breaking news from the IRS, updated FAQs on 1099Ks. We're then going to do a deep dive into the Secure 2.0 Act, and we're going to close with Carl's Corner talking about tax season, and Lisa Simpson will be joining him for that session. And then we'll close out with the open forum. So here's the agenda that I just reviewed, and I'd like to now bring up Barry Melanson. Barry, the last town hall was on March 3rd. This is actually our 95th town hall since March of 2020. And a lot's happened, Barry. Like always, it's been a busy 3 weeks. And you and I, just before the start of today's show, we were talking about, the last 2 weeks, in particular on Thursday, March 9th and 10th, you had the starting of the banking crisis. And over the last 2 weeks, there's probably been hundreds of thousands of calls from the 5,000 banks in the United States to their clients. And there's just been a lot of discussion about this with the firms as well. So, but anyway, welcome, Barry.
Thank you, Eric. It's great to be with you. Yeah, 95 town halls. And one of the things that is true today and has been true in the other 94, there's no shortage of things happening in our world and our society to be speaking about and giving all of our great members that are participating updates on. And as we barrel forward to 100, I'm pretty sure we won't have any shortage of issues between now and then either. Yeah, the banking situation is pretty interesting, and it has accounting ramifications to it. It probably has broader societal ramifications. If you think about it, this really was, as it related to Silicon Valley Bank, which sort of was the tipping point in this environment. It really was an environment in which, social media played a big part, maybe for the first time in one of these elements. And really the notion of liquidity versus really insolvency or anything along those lines. The bank was actually pretty well capitalized and with a 10-to-1 ratio. And I really think for a takeaway, we need to understand first about the bank a few things. The banking accounting rules, and there was an audit, shortly before, but the banking accounting rules require the banks to determine the securities that they hold as to whether they hold to maturity or available for sale. And if they're hold for maturity, they are recorded essentially at cost, and with a disclosure on the fair market value. And if they are held for sale, they're marked to market, the terminology. And that's the case with this. And I know most of you probably haven't looked at the balance sheet of the financial statement, but on the face of the balance sheet, the third line, there's the notion of securities held, and those securities were primarily treasuries and other securities backed by the United States government. So very safe securities that they were holding to maturity. And, on the balance sheet, they were at about, recorded at about 91 billion. And in the line, describing the line on the face of the balance sheet, it talks about the fair market value of that set of securities at 76 billion. So a big gap. And in the MD&A, liquidity of the bank was mentioned 87 different times, 9 of those talking about specifically liquidity risk. So there's ample disclosures there that took place. And in the footnotes, one last point, I don't want to get too technical, but in the footnotes, it talks about the securities. And the securities, the yield and the maturity time, about 94% of the securities that they were holding to maturity were 10 years or greater, and their weighted average yield was about 1.6%. So you can see in this sort of macro notion of increasing interest rates with a 10-year hold period at 1.6% average weighted average yield, you have this gap, and that's where the sort of the macroeconomics really started to play out in this environment, exacerbated by they were the bank with the largest amount of over $250,000 of balance in the deposits. So it was sort of a convergence of the macro, the policy issues of fighting inflation and all of those things that really played a big part of this. But the audit did cover all of these factors, including the liquidity risk.
Well, Barry, I'm not even looking at the questions right now, but I'm sure there are a lot of questions that did come in just on what you just covered. The accounting treatment, there's been a lot about that in the press, as well as talk around the audits. When you also just step back and you think about the firms that are out there, they're supporting outsourced accounting services, client advisory services. That first weekend, we were actually quite active with a number of firms. We were active with our partner, Bill.com, that processes, hundreds of millions of payments, billions of payments every week, and they do it quite effectively. And it gave us a moment to kind of think about both the systemic risk and the processing risk. And we put some videos out related to that. But I think this also provided an opportunity for firms to think about this line of business, as well as to think about how they want to advise their clients related to their overall banking strategies. So first, just on when you're processing a lot of payments, it's actually good to have diversification. And that's one thing that Renee Lacerte and I talked about, to have different options. And that's what the firms did have that were leveraging Bill.com. And because if there's a systemic risk, if the bank goes under, you want to say, okay, I want to have the ability, or just gets frozen the way Silicon Valley Bank did, to move money through other banks. And then the other item is just, you think about processing risk, because you could have a processing issue at a bank that is financially healthy. Again, diversification helps there. So just, you learn from these types of things as lessons learned, and everybody's going to do a lot of Monday morning quarterbacking, talking about, what could have been done to maybe foresee this sooner.
Yeah, there's multiple parts in what you just said. First, let me start with, the equity holders in the bank were actually very interested in going through Chapter 11 or whatever, because the underlying values, when you think about hold to maturity, actually were pretty strong in the bank. But what you just described is that people focus on deposits, and of course FDIC insurance, and we all know that the federal government has said, all the deposits are fine, and we can come back to that point. But there's also this float notion of transactions in the system that are not, really technically deposits. And they exist with electronic bill payment, they exist with payroll and other types of activities. And I think the vulnerabilities there were really sort of brought to light, and really who's doing that and how they're managing it. You and Renee did a great job of talking through that in a video to help people understand and be able to communicate to their clients, how this all works. And very significant companies, including Bill, said they were staying behind that, and all of those things would have been protected, but it's a timing issue. And so companies with the ability to do it. And then on the deposit side, the reality is in numbers today, you don't have to be a very big business to need cash availability in businesses in excess of the $250,000 that are there. And so that diversification point that you talked about is very, very critical. And I would add to it, and we can talk about this, but I think it's so important for the smaller banks, the community banks and the regional banks, to be a really critical component of our banking system, and maybe our entrepreneurial system is the way I would say it. Everyone on this town hall either knows somebody or has clients or work for somebody that, entrepreneurially started their business with, a loan that was collateralized by a house or a second mortgage or property. And if we just have the concentration in the biggest banks, which are really important to our system as well, that's a much harder play than to go to that local bank or that regional bank, which understands the market that this entrepreneur is in or what their home is in and their collateral is in. And, I think there's tensions in that today. There's tensions in that system today. So you have the floats like bill pay and payroll and things that you have to understand that the companies are going to stand behind those things. There's a timing issues to a large degree. And then you have the deposits, which the federal government has tried to address, and people are pushing back a little bit on, saying, is this a federalization of our banking system? You have the accounting rules where, people are saying, well, maybe hold to maturity should be mark to market. And of course, a lot of other people arguing on the other side, no, that's not the case. And then, of course, you have the direct deposits and what those balances are. I think just sort of like we just talked about, it is a fair discussion with clients and helping them understand that, but helping them understand that local banks are a really critical part to most, there's millions of small businesses in this country. And that's a pretty important part also of their viability. And people need to think in that systemic way about what really happens in the entire system, I think.
Yeah, that's well said, Barry. And these moments, this is another defining moment. It was obviously a defining moment for the banking community, where I've talked to a lot of CFOs, talked to a lot of firms, and they said that the banks have called 2 or 3 times over the last 2 weeks to talk about their banking relationship. That's important. And it's a defining moment for the firms as well as for CFOs and people in the finance department to be communicating about, what their strategy is, to be thinking about it. And I think, that's what we've learned a lot with these town halls, is that this is an opportunity for us to bring our best available information, and also just to talk with the firms and the finance leaders about, here it is, here's another defining moment where your leadership is important. And Barry, I know you've talked a lot about this, because that first weekend was very stressful. Things have settled a lot, but when it's stressful and you don't have certain information, it's still very appropriate to open the dialogue and to have that communication.
Yeah, and again, one of the first times we've had one of these situations has really been fueled through a social media world that we live in, right, which changes the dynamics. So everything you just said, I would agree. And I think CPAs having those conversations with their clients at a very high level. You don't have to get to this real technical element, but people need some understanding. If you go back, I hate to do this, but to COVID, the very first time we had town halls, we talked about being the 95th. We talked about 3 different principles that were important for the profession. And one of the things is that we bring, as a profession, we bring confidence, or we bring understanding to so many more people. Our members, as an example, work for 162,000 different companies around the world. Think about the contact point that our members have. And that is a really powerful element of communication in these types of things. I would also add, and we also say this on town halls, you hear a lot of different talk about tax bills and State of the Union addresses on that we're going to do this and that. And we try to remind members that just because people talk about these things or say they're going to pass legislation, these things don't all come to pass, right? In fact, very small number of things that's talked about come to pass. And you're going to hear that in this as well. You're going to hear all kind of proposals. There's already been hearings primarily focused on the regulators. There's going to be more this week. There's going to be hearings next week. You have members of Congress on both sides calling in both houses of Congress, talking about we need to do this, we need to regulate this way, et cetera. And that becomes part of the dialogue, but it doesn't necessarily mean it becomes part of what legislation will be, just like the debate on mark to market on hold to maturity. And there's a lot of reasons why for banking that maybe mark to market is not the correct answer. It's certainly been debated many, many times over the years. And so I think it's this dialogue point of helping clients or helping tax clients or corporate clients really understand that. But think about the diversity point that you said, and think about, depending on the size of your cash flows, how you do e-billing, what company is it, or e-payments, what company is it, how, were they there to stand behind things? Same on the payroll processing, because those can affect the sort of your ability as a business to meet your current obligations. But it is a system that works. It's just
Yeah.
we learn new parts as we go through.
Right, and I think that's a good way to conclude this. You're always learning new piece parts of how things work when you have a crisis like this. I've seen some questions come in about, people saying, hey, I'm rethinking a little bit about my client advisory services area. I actually think this is an opportunity to show the strength of a firm, of having a professional accounting firm supporting a small business, because you can do all of these things, and you can set up things in a much more sophisticated manner for them to have the diversification, to have the innovation. I'll close with one final comment about the community banks. Barry, really appreciated the comments you made about the regional banks. It's also about innovation. And last thing we'd want is like 4 or 5 national banks in the United States. You want to have a lot of banks to help drive innovation, because there's a lot of smaller banks that have helped build new capabilities that then the larger banks adopt. So not
to pick on the larger banks there, but go back to PPP. Remember how the larger banks were very narrow in who they did PPP loans for, right? And it created bottlenecks in the system. So community banks in the neighborhood, if you want to call it that understands that geography, they are absolutely essential to this vibrant private company business sector we have in this country.
Yeah, it's what drives a lot of business success. So moving on, let's bring the slides back up. We've got some movement related to Section 174, Barry.
Yeah, there's a bill that's been introduced. I know this has been the R&E expensing issue has been a big topic on town halls, rightfully so. There was a bill, you recall, last year that didn't get through the Congress that would have allowed for continued expensing as opposed to amortization. There has been a bill introduced in the Senate. We have written in support of addressing this issue, fixing this issue. The reality is, as I just said, when people talk about legislation, it don't always come to fruition. This is going to be a hard bill to pass as a standalone piece of legislation. And so the reality here is that if there's another piece of legislation that has tax sections in it, as what's called a tax chapter in the bill, then the likelihood of passage goes up. And we all understand the January 1, 2022 element. And, we obviously are supporting on that particular point. And then secondly, Eric, to talk about the wording that our listeners and participants will not have seen before, the tax extension simplification proposal. I'd like to share that. Yeah. This is really hot off the press here. I'd like to share that with our listeners. We talk about services from the IRS, and there is a lot of issues there. And we know there's a funding issue, and we know there's systems upgrades that need to happen. But even if all the funding was there and there was just commitment, and Danny Werfel as the new commissioner comes from a systems perspective, even if there was an immediate commitment to fixing the systems issue, let's call it, that's going to take years. It's not going to solve this tax season, next tax season, the next tax season to a large degree. And so what our tax division, which is made up of our team, our staff, and technical components, as well as a whole series of committees, including our tax executive committee, they looked at what are the real things that we could do, maybe in the short run, to really change some of the elements that create bottlenecks in the tax season. And there are really the two primary ones. There's more than two, but the two primary ones. One is this convergence of K-1s and the extended due date, which is not what this point is stressing, which we're going to continue to work on that. But the individual and corporate extensions, which require tax calculations in order to make sufficient payments and protect the underpayment penalties that go into that particular process. I'm not going to try to talk all the technical parts because people in here are much more technical than me. But the reality is that what firms tell us is that their people have to take those particularly individual files, but what I'm going to talk about applies to corporate or individual. They have to make these calculations to get their clients to pay this amount in. There's a lot of guesswork in it. And then when they pick it back up months later, all of that's sort of forgotten, and that you have to almost start from the beginning. And so the proposal is to create a safe harbor that says, just like we have safe harbors when we look at underpayments during the year, why can't we have a safe harbor on an extension? And so don't hold me to this number, but let's just assume the number for a second, 125%. If you have paid in 125% by let's just use April 15th for individuals, by April 15th, then you would not be subject to, when you ultimately file the return, just an underpayment type of situation. And the concept here is that's a really easy calculation. Maybe people are at 125%. Tax clients probably won't object to that. They probably got quarterly estimates coming. And so it's a really easy thing to get into a safe harbor position on an extension so that you don't have to go through all of the mismatch and guesswork and gathering of information that goes into preparing an extension. This would take legislation, and we're working right now to find sponsors for legislation. And like the R&E issue, it's probably not a piece of legislation that would pass on its own, but we want it in the sort of the dialogue. In fact, our governing council is going to be meeting in May in Washington, D.C., and we send hundreds of people up on the Hill, and this is going to be one of the issues they're going to be talking about, so that it's in the dialogue, and if a piece of legislation is moving, that we can put that in and give some relief around that April 15th, or for corporates, different deadlines that come into play from that standpoint. And so it's intended to be a simple, get it done and not have to go through all those tax calculations approach.
Well, clearly something we'll be talking about more in future town halls, and look forward to how we'll be advancing that at the May council meeting. So Barry, we've kind of hit on Warfel. Why don't we move to this final topic before we bring Lisa Simpson up about advancing this important issue related to supply chain and auto dealers?
Yeah, it's really related to LIFO inventory, right? I mean, so supply chain problems created in COVID created, difficulty for anybody on LIFO to replace their inventory in a short order. There is now a piece of legislation that has been introduced to give specific relief, not to everybody on LIFO, but to automobile dealers on LIFO, that would give them an extended period of time to replenish the inventory before actually having to pay the tax that would be due for the sort of the turnover of LIFO inventory. And I think the focus on automobiles is, I don't know this for a fact, but you can see that the focus on automobiles is because of the particular disruption that occurred in that particular industry. But that legislation is out there. We have called on Congress to defer that aspect as well, or to address that particular aspect as well. And we've been vocal about the need to Section 473 to address that issue. This one actually, because of the automobile industry in this country, actually has a greater chance of moving as an individual standalone piece of legislation. And of course, as it does, then that maybe is an opportunity to try to look at the R&E credit or this tax extension simplification provision that we talked about before.
Well, thanks, Barry. Quite an update there. We now are bringing up Lisa Simpson, who everybody knows, to kind of take us to this next section.
Thank you, Eric. All right, let's hit some technical topics. So we're going to start with some late breaking news that Eric foreshadowed. We've got some hot off the presses, updated frequently asked questions on 1099Ks. We love to talk about that topic. So on the next slide, we'll have a link to the resources that the IRS put out just yesterday. So literally hot off the presses. And I'm going to skim at a high level because I'm really going to encourage you to go read the details and read the examples, because they give examples that I think are going to resonate with your clients, talking about selling a used refrigerator and those elusive Taylor Swift concert tickets. So if we look, I do want to point out one thing. If you go to the top of the FAQs, they say they updated general question 3 and then individual questions 6 and 7. So when I was reading through it, I got a little confused. So that general and individual is really important if you're trying to get to the right spot on the updated FAQ. So little friendly tip, don't struggle like I did. So the first update that they gave is answering the basic question: is there gain or loss on the sale of a personal item used to compute taxable income? And is it supposed to be reported on a 1099-K? So we can all remember the drama that we had last year around the threshold being lowered to $600 and no bottom on the number of transactions. So one transaction over $600, you're getting a 1099-K. And then in December, IRS came out and said that they were going to delay that reporting requirement for 1 year. Some software or some payment providers may not have been ready for that. So your clients may be getting some, even if they don't hit the current year threshold of 200 transactions and $20,000. So the IRS is responding to a lot of the feedback that they're getting from practitioners around, what does this really mean? So first of all, we'll reiterate the point that we've made several times. The gain on a sale of a personal item is taxable and should be reported on Form 1040. However, losses on the sale of a personal item are not deductible, and you can't use them to offset. So what happens if a taxpayer got a 1099-K this year for something that they sold at a loss? And they're like, how am I supposed to report this on the return? So the IRS has updated their FAQs to give you insight into how to get that to flow through on the return. So basically just making some offsetting entries. I'm not going to read line numbers to you because that just doesn't sound like any fun at all. So again, I'll refer you to the actual FAQ document to get the details there. And then they also gave us 2 other new questions. These are related to individuals. And the first one is, what if a taxpayer gets multiple 1099-Ks and you've got some at a loss, some at a gain, or some they shouldn't have gotten? What to do? Do they have to be reported individually, or can they be combined? And basically the IRS came out and said, you can combine. You don't have to separately report each individual 1099-K. Individual question 7 was, what if they get 1099-Ks in error and cannot get it fixed before the time the return is due? My guess is that if your client got a 1099-K, it's going to be really hard to get it fixed. So luckily, the IRS has shown you how to actually report that on the return. And for 2022, they've given you another way to approach the issue. So again, you've got those FAQs. I'll just keep pointing you to those to get more of the details. And next, more news from the IRS. They have released their first 3 items as of yesterday when I did the slide, maybe a new one out today, on the so-called Dirty Dozen list. And this is a really interesting list that they produce around this time of year, because although scams and bad actors are out there all year long, they really come out in force during tax season. So they start with a warning about employee retention credits, and we're going to dig into that. So hold those questions. But then they gave a couple around scammers using email and text messages, and scammers offering to help to set up an online account and then steal your identity. So I don't know how you guys are. When I hear these stories about people getting scammed out of their money by through these text messages or phishing messages, I'm like, really? Why couldn't they figure that one out? But I've heard a couple this week that have been really sophisticated and kind of scary, actually. One was of a person who had called into tech support and everything had been fine. And then a couple of months later, bad actors got into that tech support system, reached out to him and said, oh, hey, by the way, we transferred $20,000 into your savings account, and you're going to need to give that back to us. Go to this ATM machine, deposit the money, and we'll leave you alone. Well, the person fell for it because the number seemed legit. He had talked to tech support a while ago. As it turns out, these bad actors had taken the money from his checking account, put it in his savings account. He looked at his savings account, saw the extra money, and thought, oh my gosh, this must have really happened. So he fell for it. And then another one that I just saw on a community forum was around someone's HSA getting hacked for quite a bit of money. So make sure that you're communicating with your clients about the risk of these scammers. Couple more, we're going to get into the ERC issue. So as you can see, on March 7th, the IRS put out a very strongly worded warning about dangers around ERC and highlighting the practitioners, the professionals' responsibility. So this is from OPR, which is the Office of Professional Responsibility, and they administer and enforce all of the regulations around Circular 230. So they're reminding us to fulfill our obligations, and then they give us some details that I wanted to call out for you. Again, I really encourage you to go read the full warning, but they're laying out obligations. And the first one that I've called out is diligence as to accuracy. And you'll see some of the bullets that I've pulled out specifically on the next slide. So if the practitioner cannot reasonably conclude that the client is or was eligible, then the practitioner should not basically enable that improper credit. And if they learn that the client did not comply, they should promptly inform the client of the non-compliance and any penalties that apply. So that seems pretty clear. And then on the next slide, we'll pull out some comments about the standard for the tax returns and other documents. So I've highlighted, these are my highlights, not theirs. But as a best practice, the practitioner should consider advising the client of advising the client of filing an amended return. And then this one's really interesting. If you read the warning, the IRS OPR says you can rely on the advice of others only if the reliance is reasonable under the facts and circumstances, including whether the other advisor had a conflict of interest. We've all seen those ERC mills who are taking percentages, pretty big percentages up front of the ERC claim, regardless of whether it'll stand up to scrutiny. In many cases, not all. And so that means that you kind of have to look at any third-party advice with some skepticism. So our advice is always to document, and to make sure that you're documenting your understanding of whether the client really qualifies and the conversations that you're having with the client around that qualification. We have lots of resources for you around ERC, so I wanted to make sure that you remember how to find those. We have an ERC resource library and the really helpful ERC fact or fiction that we've called out on the next slide, along with some FAQs and podcasts. We're working on a couple of other slides, so some other resources, including a template to help you with disclosures if your client used a third party, and then some information around what to do if your client has filed and you're a little concerned that maybe it'll get overturned on audit of the ERC claim, and there's a possibility that the tax return is already closed. So a lot going on there, but just stay tuned and keep your skepticism up. So that's from a tax standpoint. But then you've also got the accounting and auditing issues related to ERC. And I want to give a shout out to our Center for Plain English Accounting. They have made available in your materials today, so make sure you go in and download that, a special report that they did around non-compliance. If a client has erroneously filed for ERC and what the implications are for both the accounting and the auditing. There's a lot of technical information in there that I think is really helpful, but basically you have to, as an auditor, determine whether or not this represents a material misstatement in the financial statements, and then what to do about that, including discussing that with management, and documentation is going to be key here as well. So technical reference there, AUC 250. And then another one to keep in mind is evaluation of misstatements identified during the audit, AUC 450. I know I'm throwing a lot of words at you, but really, if you go download that that report, you're going to get some good information. And then if you have questions about the accounting side of it, we've got a Journal of Accountancy article. And then this one is fairly nuanced. If you're getting questions about software tracking changes on digital asset basis, you can read that Journal of Accountancy report. So super quick technical update, and I know we've got a lot of good stuff to cover, Eric.
And that was a powerful update. Thank you very much, Lisa. See you back in a few minutes. So we're now going to do the deeper dive on the Secure 2.0 Act. I'd like to welcome Carl Peterson and Zach Keep to join us. So welcome, Carl. Great to see you. And I'll let you introduce our partner here from Paychex.
Sounds good. Thanks, Eric. I appreciate it. It was so much to cover these days and these town halls, not enough time to do it all. But I'm very excited for this section on the town hall with the Secure Act that passed last year and signed into law right before year end. So some of the provisions actually even became effective on January 1. And already during this tax season, we've had questions coming in on provision of the Secure Act, and we have hundreds of firms actually participating in the AICPA sponsored Paychex 401k plan, and many of them are listening to this town hall today. We're very fortunate to have Zachary Keep from Paychex here to help talk about the important components of the act that impact our firms and their clients. Zach is a manager of compliance risk at Paychex. Welcome to the town hall, Zach.
Thank you so much, Carl, and thank you, Eric, as well.
Yeah, I'm glad you're here. So, Zach, I know you and Paychex hear from firms all the time. We certainly get calls and questions throughout the town hall, about the Secure Act. What are you hearing? What are the top things that CPA should be aware of, especially those things that became effective on day one this year?
Yeah, that's a great question. I think when we look at the Secure Act, the challenge is to decide what's the biggest story, Carl. There are over 90 different retirement-related provisions in Secure 2.0. I think there's one thing that everybody agrees on. No matter what you find most interesting, I think we all agree the big story. And as you allude to, the story that was effective day one, first day of 2023, is some increased tax credits, two increased tax credits in particular, aimed at sort of incentivizing one of the, statistically speaking, 74% of small businesses in America that maybe don't offer a retirement plan. Secure 2.0 takes steps to encourage them to offer that plan. And the steps that it takes really amount to a couple of tax credits. The first one, I'll just delve into it right now in the interest of time. The first one is actually a little bit of an extension of what we saw with Secure 1.0. Of course, as the name implies, Secure 2, there was definitely a Secure 1 all the way back in 2019, maybe overshadowed a little bit because we all know what happened in early 2020. But the Secure Act 1.0 established a very lucrative tax credit paradigm for some of the smallest employers establishing a plan, and it proved very successful. So Secure 2 took the next step, starting on the first day of 2023. For the very smallest of businesses, those employers with up to 50 employees, the amount of the tax credit doubled from what they enjoyed under Secure 1.0, went to a maximum of 100% of startup costs, capped at $5,000. And what that means in practice, maybe at the risk of oversimplifying just a little bit, but for some of those very small employers, it is close to, maybe even essentially free to start offering a retirement plan. Those startup costs come back to them in the form of a tax credit. And that's only for new plans. Unfortunately, it can't be claimed by someone with an existing plan. But as we work with our client base, as you all work with your client base, be sure to keep in mind that right now there is a great benefit to commencing a 401k or other retirement plan. It's also important to note that slightly larger employers were not left out by Secure 2.0. Those larger employers in the 51 to 100 employee space, they still benefit from the Secure 1.0 structure. They're looking at a 50% tax credit up to that same limit of $5,000. So still out there, still lucrative, maybe a little bit more lucrative for the very smallest of employers.
Yeah.
Exactly. Quick question here. I mean, one thing with the 75% or 74% of small businesses that don't offer this, I mean, this is one way to kind of really drive retention. I mean, is that something that you find in some of your studies?
Yeah, I think that's absolutely the case. The war for talent is something that we've all spoken about quite a bit over the course of the past year. And, you know, a retirement plan is a great way of retaining talent. I think that's actually maybe a very good segue into that second tax credit. You know, the first tax credit incentivizes the establishment of a plan. The second tax credit kind of incentivizes offering a robust plan. And to your point, Eric, offering the type of plan that is going to maybe encourage an employee to stay. And it does that by creating a tax credit that's tied to employer contributions. And, you know, the industry spent years thinking about what Secure 2.0 was going to entail. I think the day Secure 1.0 passed, we all started thinking about Secure 2.0. I don't mind saying that this was almost a little bit of a bonus. I think this caught a lot of folks by surprise. But what this does is it allows an employer who makes employer contributions. And the dictionary definition of employer contribution, of course, is a matching contribution. Employer matches 3% of employee deferrals to a 401k. Well, if they do that, they can claim that amount contributed as a tax credit up to $1,000 per employee. And, you know, unfortunately, the bad news is this is not a permanent deal. It does phase out over a period of years, but for the first 2 years of a plan's existence, after its birthday, those first 2 years, the employer can claim 100% of those tax credits. And then it starts decreasing, 75% in year 3. You all can see the chart eventually going away in the 6th year of the plan. But I think this is really a phenomenal incentive for employers. And it's great for employees as well. Like some of the other tax credits, maybe a little bit more targeted towards those very smallest employers. Once you cross that 51 employee threshold, there is a formula that's applied that slowly phases that employer contribution tax credit out. I would say, we're happy to answer questions about that. It can vary a little bit depending on the size of the employer. But bottom line, for employers establishing a plan now in 2023, these tax credits are a huge benefit, and they are available today for all employers.
No, that's great. So, I mentioned earlier that, we have hundreds of firms that are involved in our, in the Paychex 401k plan that we, work with you. And for those existing plan holders, what are some of the, opportunities and changes that can impact the plans that are already in existence today?
Yeah, well, let's take a look. If we move to the next slide, we'll kind of see where we stand with Secure 2.0 and a little bit of Secure 1.0. What's in effect retroactively, just a quick word about that. Those tax credits that had their genesis in Secure 1.0, lots of discussion in the industry about whether they would apply to a multiple employer plan or a pooled employer plan. A technical fix with Secure 2.0 and good news to boot, those tax credits apply. I know everyone's probably happy to learn that. In 2023, There are some changes allowing plan adoption as late as the tax filing deadline. For those employers making an employer contribution, great benefit for them and their employees. Of course, we have the tax credits that we just talked about. That's in effect today. And then some changes to RMDs. Really nothing new there. We all know RMD ages change from time to time, increase to 73. And with time, of course, there's going to be further increases to their RMD age. And then if we look forward, unless there's any questions about today, let's take a quick look down the road a little bit. Starting in 2024, there is going to be the ability for an employer to match into a 401k payments that their employees make on their student loans. Student loans, of course, are a hot topic right now. We all know. And Secure 2.0 ties together student loans and retirement, I think probably for the first time. And this is going to be an interesting benefit. There's going to be a lot of desire to see this. I think desire on the part of those talented employees we all want to retain. For better or worse, though, the industry is in a position where we're going to need to wait for some guidance from Uncle Sam on how this match is going to work. And I would expect we'll see that soon, just given the 2024 date. Go ahead.
I was just going to say, if we go to the next slide, you can maybe, what should firms be doing today with their clients as we get to the end of the tax season here, and everybody's talking about, what am I going to do for 2023 and going forward? Yeah,
the story for now is tax credits and RMDs. I think, especially for the gang on the call here. I also think, it's worth being aware that there have been some changes to how folks can access their 401k in the event of an emergency, some simplification when it comes to getting a hardship, a new distribution type that allows an employee to simply withdraw $1,000 as needed for an emergency. So I would say familiarize yourself with those provisions, the RMDs, those tax credits, and some of the emergency options out there. That's going to get us through 2023. And with luck, I'll be back to talk to you more in 2024.
Hey, yeah, and Carl and Zachary, we're going to have a resource at the end where they can get more information from a previously recorded webinar related to Secure 2.0, the Secure 2.0 Act. So thank you very much for this overview. We're now going to continue on and close out, Carl. So Zachary, thanks for this update. And we're going to close the final session with you, Carl, and Lisa, you providing some of your thoughts on the tax season.
Right.
All right. Hey, Carl, good to see you again. So, Carl, you talked to a lot of practitioners. So just give us a general overview. How's busy season going?
I'm just happy they talked to me during tax season, but everybody's busy. But I'll tell you, the general sense is it's way better than it's been the last 3 years. And what the last 3 years are like for us and for our members. It's crazy. So in fact, somebody the other day, I ran into somebody over the weekend and they said, this is the best tax season in the last 7 years of practice. Yay.
Wow,
right?
That's awesome.
Yeah.
So now spoil that for us by hitting on this nexus issue that you brought up to me when we were talking earlier this week.
Well, I'll tell you, just last week, a small firm member reached out to me with this question about the requirement to file a pass-through entity return in another state, and the state was Pennsylvania. And, we looked at the facts and circumstances like, oh my gosh, the only thing that happened was this partner moved or lived in Pennsylvania, and they were a partner in a partnership that had no activity in that state, had, so zero activity, no physical nexus, no economic nexus in that state. And yet they found out they were required to file a tax return in that state. And so, as we got into looking at this a little bit more, it amazed me, of course, that even existed, because you think about nexus in itself, it just wouldn't apply. But there are actually 7 states, as you see listed on here, that if you have a partner living in that state, regardless of the activity, totally zero, any activity, doesn't have to have any, the partner lives in that state, you're required to file a tax return, a pass-through entity tax return in that state, and provide a K-1 to that. Make sure that partner in that state has that K-1, even though it's likely to have zero reportable income on there. So it is worrisome.
Yeah, that's quite the wrinkle to throw out there. And with the mobility of everyone these days, I wonder if other states are going to start enacting laws like that as well. So interesting.
Right.
All right. So let's pivot back. It's March 23rd, a little over 3 weeks to go. What should firms be doing now? And how do you think it's going?
We could probably touch on the last 3 bullets all at once, right?
Yeah.
Everybody at this point should be doing extensions, should be prepared to do them. I think back, we used to have a requirement that people get their data in by April 1, and that got to be a burden. It's like, that doesn't make any sense. So we moved ours back to March 21 at one time. And, if you think about it, and you were in practice too, when you get to April 1, the likelihood of getting any of those returns done that come in, at that date is almost zero, right? And the other thing is you're trying to get returns done that you've been working on, and clients finally get the last bits of information in, and you want to get it out. But at the same time, maybe those are the returns that should actually get extended as well, because time is running out. You're going to get more data in from other clients you haven't even touched. And how do you even really get through those returns to determine today what their tax liability might be just to file an extension? So just as you try to manage client expectations and everything else, this is, the pressure is just getting greater and greater. And, I talked to people today, and they're just already looking at the next 3 weeks and 2 or 3 days, and the pressure is there. I'll tell you one of the things that we did, and I'm kind of hesitant to even mention this, but you get so much pressure on you. What happens is that last few days, if you're not done by the 14th or 15th with extensions, and you need to get something out, you really physically can't even get it done, or mentally can't even look at the data. We would end up calling the client and say, how much money do you have? Because we have no time to go through and no idea what you're going to pay in taxes, but let's pay something in. So how much do you have available? How much is in your bank account? And we'd say, we're going to spend all of that. And one of the positive things by the way, that is, if you push them to probably overpay, they're going to get that data to you and be very responsive, so they can get that back as soon as possible.
So 2 things. First, I'm going to flip it and tell you a success story. I was talking to some practitioners earlier this week, and Renee, a small firm practitioner in Texas, said that she basically managed her clients' expectations and communicated in advance, and she took spring break off. So it's March 15, and she took a week out of the office because she had set the expectation with her clients. We're going to extend. We're going to manage this. And she took some time out to recharge and refresh. And I see that Eric's coming back in. So I want to give a shout out to the 200 or so people that helped me with the data point that we've got circled on the slide. Most of our respondents, that the 200 people, said that March 15 was their deadline for getting client data in to still get the return done by April 18th. We actually did have a couple people that said April 17th, and boy, I remember those days. That's stressful. So
one last quick comment, by the way, you need to hold to those deadlines, because you'll find out, as we did, there's always those returns. You go, well, I'll just go ahead and get that done. I'm already done by the 14th. I'll just get that one done. Well, what does that tell the client? And next year they come in and say, no big deal. I don't have to worry, because Carl's still going to work all night long just to get that work done.
Good point.
Well, great session. And one thing that, Lisa, we always do in the town halls, we end on time. So we got 5 more minutes here. So now we're going to move into open forum and bring Barry back up. We can drop the slides. So Barry, and Lisa, I'll do the first question, then you can jump in with one. Barry, a lot of questions, or a lot of support, I should say, related to the safe harbor proposal. But also maybe just if you could clarify it one more time. One question was 125% of what? So just do
the prior year's tax. The prior year's tax. So it's a simple calculation, just like underpayment penalties is generally off of the 100% of the prior year's tax. This would be a higher threshold. Again, don't hold me to the 125%. It could be a different number, but it would be on the prior year's tax. So it's a very simple calculation.
And then likelihood, probability, as you said, you're going to be putting council to work in May on this to bring this message to the Hill?
Well, it's always dangerous to predict high likelihood in this, polarized political process. And frankly, there would be the way that Congress prices things, or the way the Office of Management and Budget prices or cost provisions, because some of these payments on the extended due date would actually fall to the next year. There will be a price tag associated with it. We all understand it's a cash flow point, not really a revenue point. But that's not how the government estimates impact. It'll take work. But I do think, the human capital challenges that's in all industries and certainly in our profession, all of those types of things give us a lot of possibilities to talk about. And frankly, the difficulties that the IRS is having gives us an opportunity to make this particular point. So we think it's a good opportunity. I wouldn't say it's for sure it's going to pass. That would be foolhardy to say that. And sometimes these things take more than one attempt. The reality is this Congress is for this year and next year. So our goal would be to work it really, really hard during this 2-year window.
So Lisa, is there anything, there was a bunch of questions related to the Secure 2.0 Act presentation.
Yeah, lots of questions, but I don't want to throw them at Zach without making sure that he's got the answers, because nobody likes to be treated like that. So we're going to come back to Zach with the questions, and then we'll send answers out in the follow-up newsletter next week. So shout out to you guys who are setting your February 25th client deadlines. So thank you for sticking to those deadlines, and we appreciate your input.
Okay, well, thanks, Lisa, and that's a great way to leverage this question set, which we look at every week, and we'll get some answers out in the newsletter. So thanks again, Zachary. Thanks, Carl.
Thank you.
We're now going to move to these final slides here. You've got the in summary, which you can leverage. Please do leverage these slides with your firm and your clients and companies. Here's this on-demand webinar, which will give you a deeper dive into the Secure Act 2.0, so you can access that. Here's the most recent town halls. And here's a slide that we wanted to highlight for you. We are on the 95th town hall, Lisa, and we got the countdown here to number 100 power hours we've had with you. So April 6th, we've got Aaron Collins from the IRS coming. We've got Jan Lewis, who chair of the tax technical committee. Mark Koziel, who was with us at the start of the town halls, is going to be joining on April 20th with Rachel. We've got Tom Hood and Dan Hood joining us on May 4th. And actually, we're going to have a member of the Squawk Box, Steve Leisman, join us on May 18th to talk about, we didn't get into it today, Barry, but the Fed's rate hikes and where things are going. Steve's an expert there. And Barry, you will be with us at Engage. So Lisa, Barry, any just final comments here as we kind of, march to 100 and continue to be with this wonderful town hall community?
Lisa,
I love the feedback that we get. People continue to say that these are helpful, and that's really meaningful. So thank you for staying tuned with us all of this time.
What I would say is, first off, we only get to 100 because of the incredible participation of our members and our participants. So thank all of you. And I'll brag on our team that puts this together. They do a remarkable job. They do a lot of hard work, and your feedback is a big centerpiece of what's on the next show and the next show and the next show. So thank you all.
Thank you. So we will see you on April 6th. That's all for now. Have a good end of tax season.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.